When companies have significant amounts of accounts receivable, they may decide to use those accounts receivable as collateral on loans. Remember, an accounts receivable is an asset. In order for the balance sheet to balance, the liabilities and equity have to equal the amount of the receivables. If receivables are going up, then there is a need for additional debt, in some cases factoring or pledging of accounts receivable is used. The pledging is not exactly the same thing as factoring. Factoring is an outright sale of the receivables, and when that happens, of course, some of the risks of loss, the risk of loss on the receivable, are being transferred as well. The advantages of using factored or pledged receivables is that as the asset increases, the receivable increases, you're able to directly tie the increase in liabilities to the increase in assets. So the borrowing is tied directly to the level of asset expansion. The real disadvantage is that using receivables is a relatively expensive method of acquiring funds, and once receivables have been factored, it may be more difficult to actually borrow money in some other manner because those assets have been stripped out and are no longer available. If a bank, for example, needed to collect on a loan, they can't expect the repayment of receivables that are outstanding to go toward repaying their loan, because the factor that has purchased those receivables will be the one that receives the money there. When receivables are pledged, the lending firm decides on the receivables that it's going to use as collateral, and then there will be a loan with an interest rate that depends upon the financial strength of the company and also the creditworthiness of the company, as well as the quality of the receivables. The interest rate that a company is going to have to pay is well above the prime rate, and it's computed on against the outstanding balance of the loan. When receivables are factored, they're sold outright to a financing company, and the financing firm, the factoring firm, doesn't have recourse against the seller of the receivable. He's basically stepped in and said, I will pay you for the receivables and I will bear the credit risk at that point. The finance company may do its own, or maybe only rely on its own credit analysis of the quality of the receivables, the companies that owe the firm money. And so in the end, the factoring firm's absorbing the risk and collecting a fee, and the firm that sells the receivable is getting paid up front rather than waiting until it receives payment on the receivables. It's getting its money up front by simply selling off the receivables on the front end. Let's consider an example of factoring receivables. If $100,000 a month is processed at a 1% commission and a 12% annual borrowing rate, what's the total effective cost computed on an annualized basis? So the firm is going to purchase $100,000 every month, basically, since we have 12 months in the year. So there's a 1% commission. There's a 1% interest, or a twelfth of 12%, 1% interest every month. The total monthly fee, therefore, is 2%. But that 2% is going to be incurred 12 times a year, so the annual rate of interest is 24%. Now, you might look at 24% and say, gee, that's awfully high, but you also have to remember that the receivables might be unusually risky. If the firm is making sales to companies that occasionally go out of business, that sort of thing, they may not be paid. So 24% may be a perfectly acceptable interest rate given the level of risk that's involved in collecting the receivables from the various companies that owe the money. The benefit of this, in large part, is, or one of the benefits is, that it allows the firm, the selling firm, to pass on a lot of the credit checking costs to the factor. So rather than having to monitor credit quality themselves, the company that's buying these receivables is going to insist upon sales only to relatively high quality customers. In recent years, there have been an increasing trend of using public offerings to sell receivables rather than factoring. There are a number of reasons for doing that. How robust this will be as we come out of a financial crisis where asset-backed securities have performed poorly, we'll know a little better in a few years. Suffice it to say that asset-backed public offerings fill very much the same role as factoring does. There are obviously some risks that probably are greater in a public offering, in that the ability of the lender to scrutinize carefully the securities is probably more limited, because no individual lender has the benefit of all of the scrutiny. If they scrutinize on behalf of the whole group, they bear all the costs and don't get all the benefit. So there are clearly some limitations as to the use of public offerings of asset-backed securities.